Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. Before we get started with today's episode, Blockworks is hiring for our podcast Lightspeed. We're looking for someone to co-host the show and interview the top builders within the Solana ecosystem. If you're interested and think you'd be a good fit, check out the link in the description to apply. All right, let's get into today's episode. I am joined by Philipp Carlsson, Global Chief Economist at the Boston Consulting Group and author of Shocks, Crises, and False Alarms, How to Assess True Macroeconomic Risk. Philipp, great to meet you. Welcome to Forward Guidance.
It's great to be with you. Thanks for having me.
Philipp, we can talk about shocks and crises in a minute, but I first want to ask you about the false alarms in the title. What were you referring to? Because there have been a lot of economic false alarms over the past 4 or 5 years, haven't there?
Yeah, that's right. I mean, just when you think about, say, 2020 through the present day, I count at least 4 or 5, starting with the pandemic itself. When that hit, the common received wisdom was this will be a protracted, really long recovery, more like 2008 and maybe as bad as the 1930s. Instead, we got a very swift, very tight recovery. Then you had the inflation spike and the headlines veered into 1970s inflation meltdown. That wasn't to be. We've gone from 9 to 3% in less than a year, or basically a year. We're not out of the woods, but clearly it's not an inflection point. It's not a structural break. Then when interest rates rose, the narrative was we're going to see a cascade of emerging market defaults, sort of Asian financial crisis style, late 90s type problems. And that hasn't come to pass either. And then, the most obvious false alarm is the so-called inevitable recession of 2023, which, is nowhere to be seen. And I think it's just the latest in a long series of narratives that just are too nervous, too loud, and essentially false alarms.
And let's take that inevitable recession of 2023, which was widely forecasted in 2022. I thought it was likely. I interviewed a lot of people who thought it was likely as well. I remember a Bloomberg headline from Bloomberg Economics saying that there was a 99% chance of a recession. As you said, many people thought it was inevitable. How would you diagnose that false alarm? And I should say, of course, we will have a recession in the future, and we could have a recession that is imminent. But if there's a prediction made in 2022 and it's 2024 and it hasn't clearly happened yet, it was a false signal. In economics, being early is the same as being wrong. So how would you diagnose the false recession signal?
Calling the cycle has always been tough and always will be tough, and there isn't a shortcut or sort of magic wand that will solve that. But I think there are a few things we can do, and the book goes into some detail on what these are. Essentially, the idea that we can call the recession top-down with the help of models, be that yield curve-based or other indicators, I think that just is false. It's just not going to happen. In the end, you were better served in 2022, 23 to look at it more from a narrative-based perspective and the distribution and the nature of risks that can give you a recession. And that's what we did. And we were a lot more upbeat on the cycle in 21, 22, 23, avoiding the recessionary call in our publications. Why? Well, we looked at it in terms of different recession risks. You're either going to have a real economy recession, based around consumption, investment, labor market, et cetera, or you have a policy recession where policymakers on the monetary side screw it up, or you have some kind of flashpoint and crisis in the financial system. Between those 3 types of recession, you can ascribe all prior recessions, and I think all future recessions, you'll be able to ascribe them to those 3 types of downturns. And then you can narrow down a little more. Well, the real economy recession was a high bar in those 22, 23 scenarios. I mean, the labor market was booming. Consumers were, while they self-reported misery, their spending was remarkably strong. The housing market wasn't going to give you the sudden death. So it was really hard, I think, to argue and to pin this on a real economy sudden stop. That sort of led you to policy era, which was sort of the obvious story to look at, and the risk was elevated. So, you ramp up rates the way you did. Of course, recession risk was very, very material. I think where the thinking often went wrong in those years was to assume that it has to and must deliver the recession. Well, it didn't. And, financial conditions signaled some of that. There were other reasons to believe that the tightness that we saw in terms of the policy rate may just not be as tight as that seems, and that the resilience of the real economy may be much bigger in absorbing these higher rates. And then finally, the third one, financial recession risk. You had flashpoints of that nature, right? SVB was such a moment where you said, okay, now this is hitting us again from the financial corner of the risk spectrum. But as we saw, policymakers can and do act. They have incentives to act. They did manage to de-risk that situation. And I think there will be other such flashpoints. But are we going to get that big financial system meltdown? I think the bar is really high. And the book also talks about that. So really, it was about policy error risk. And if you looked at that, yes, recession risk was high, but it was not a foregone conclusion. And so we're here in a non-recessionary economy, and the world looks a lot better than all the doomsaying we had.
So recession can be caused by three things: the real economy, monetary shock, higher interest rates, or financial collapse. I think when I hear financial collapse, I often think of credit because an equity bubble popping often is not enough to slow down the economy, even though there is the wealth effect. And Silicon Valley Bank, they lost money on interest rates and they had a bank run, but it was not at all credit related. Defaults and delinquencies have been very, very low. They are rising. And then, as you say, in the real economy, we started at such a high level of nominal spending and job creation. Would you say that the biggest risk of those three factors in 2022 was the monetary shock, given that we went from 0 to 5.3% on the federal funds rate?
Yeah, so the way I frame it in the book and would do so now, sort of the area of risk would be the policy era. You're moving very fast. You don't know, how fast is too fast. You don't know how high is too high. So the risk from the monetary side was certainly the biggest of those three risk factors. And, the transmission channel into recession might have been that it's too much from the credit side, that households set back or step back too fast, too far. That was the biggest of those three risks. But it was not at all a foregone conclusion, and it wasn't enough of a pressure point that would have delivered the recession. It didn't.
And why did the move from 0% to 5.3% not deliver a recession? It is hard to, in terms of a monetary shock, that is substantial. In terms of absolute level of rates, Volcker was bigger, but Volcker didn't start from zero. So it definitely is there. The history of monetary shocks, 2022 is there. Why do you think it didn't cause a recession?
Well, look, the underlying strength in the real economy was and continues to be significant. Hiring, the labor market was just not going to go away that easily. There was a backlog of demand that is still there. The household finances were and continue to be significant. Savings, even though the savings rate is low, that I ascribe to high wealth levels. Wealth is high, savings rate drops. So there was continued strength in terms of consumption, in terms of hiring, in terms of investment. And so as we saw higher rates, it wasn't enough to lower activity and to bring down economic activity to recessionary levels. And I think ultimately, if you look at financial conditions as a proxy for what is the cumulative total impact of tightening, well, you saw that it just wasn't as impactful. All those hikes weren't as impactful as you might have thought.
How were you thinking about it? Let's say at the peak recession fear, which I would probably attribute to around the bottom in the stock market, which is October 2022. How were you judging recession risk, and how were you viewing the widely held belief that there would be a recession, as well as the soft data that seemed to confirm that, whether it was 2 quarters of consecutive negative GDP growth, or extremely negative consumer sentiment, or ISM's PMIs below 50, indicating continual contraction, as well as the many, many op-eds. Describe your thought process at that trough, as well as how it evolved.
Yeah, let's take one of the things you mentioned. Let's take consumer sentiment. That was really lousy. And that was quoted over and over again as a softening economy and the first step into the recession. I published at the time, I did an op-ed back then in Fortune, where we looked at the consumer sentiment story and what was truly happening. And we made the call and said, even though the University of Michigan sentiment numbers are lousy, we're going to continue to see strong spending. What was the primary reason that consumer sentiment was so bad? It was a real income shock. So inflation was a big shock, and it did have negative real income consequences. And you did see price sensitivity, and that factor did weigh on consumer sentiment. It didn't mean that consumers couldn't spend at all. It didn't mean that job losses were on the line, but it did have that impact, and it weighed on consumer sentiment. By the way, now that wage growth is faster than inflation, right? So inflation has dropped below wage growth, consumer sentiment has bounced back. Why? Because we now have positive real income growth. And so consumers seem to be taking consciously or subconsciously a lot of information, a lot of cues from that experienced real income change. And now that we're seeing this in reverse, consumer sentiment has bounced back. So back then, we looked at it not through a model-based perspective. We didn't think that there was the one answer coming from a calculation based on any financial market data or any one indicator or even a collection indicator. We looked at it more comprehensively and we said, look, we think the recession risk is high. We never said that this is little, right? It was very substantial recession risk. But to throw in the towel and say this is a foregone conclusion, there was too much strength in consumption, right? You had a softening in durable goods consumption, but services basically offset that weakness that unfolded then. You saw the household finances, which were remarkably strong, basically across the distribution. The housing market seemed like it could be a big headwind, but we looked at that closely as well and said, look, the inventory is too low. Like there's going to be continued housing activity just because inventory is too low for this to be sort of a sudden stop that drags down the economy. I think that the idea really is to not be misguided or too impressed by quantitative indicators derived from single data series. A lot of the data prints we've had the last few years, they're totally out of whack, right? They're totally outside the 70-year range of what is typically seen for these indicators. That comes with all the dislocations, all the disruptions, and the models. They are trained on historical data. So by definition, if the models haven't seen those data outliers, they can't make sense of them, right? So in the start of the pandemic, the kind of macro prints you got, they were literally not seen before. So how would you expect the model to give you an answer? You had to almost put them to one side and look at it in a much more eclectic, much more multidisciplinary, much more judging way, rather than just sort of quantitatively reasoning and analyzing. You had to make a judgment call, right? And the judgment call sounds less rigorous, but I think it can be a lot more productive than entrusting this to a big fat model that in the end is only as good as the data that you feed it with. And again, a crisis by definition produces data points that are outside of the experienced realm of data. So by definition, almost the model can't guide you in the moment of crisis.
Can you describe how certain data can be misleading? So I don't do any economic modeling, but I think I may know what you mean. For example, if you look at the month over month change in the absolute number of employed people, the non-farm payrolls in March, or I guess maybe it was April of 2020, the job losses were close to 20 million people in a single month, which is so much bigger than any month during 2008 or the 1940, any time in history, that it's just forget 6 standard deviation moves. The model probably said that this would never ever happen, but of course it did, as so stuff often does. How did that mess up the interpretation of future data if you start from going to negative 20 million and then in the next year you're adding so many jobs, 1 million jobs a month? Why does the previous 1940 to 2019 data not work as well in terms of making predictions?
Well, your example, I think, is a good one. The very high unemployment prints that you got in 2020, March, April, et cetera, at the start of the pandemic, they essentially led a lot of analysts, economists, others astray. Why? Because the models, they extrapolate from the level of unemployment to the recovery time. So a lot of the misconception that that would be a very, very lengthy recovery, worse than 2008, maybe as bad as the 1930s kind of situation, derived from looking at the unemployment rate as the key proxy for how good is the quality of that recovery that follows. But what was forgotten in the process by entrusting it to a model which had never seen 14% unemployment, what was forgotten is, what are the drivers of this? Why are we seeing this? Well, we had shut down the labor market. We had essentially stopped the economy. That was not something a model had seen. So the model couldn't make sense of it. And just as it went through the roof, unemployment, it also came down basically as fast, right? So it was a spike in unemployment and it came running down again. And all those who, model-based or otherwise, took the unemployment rate to say anything meaningful about the recovery time, they were wrong-footed. What did help, or what would have helped in this situation, was to think about the narrative of recovery. What gives you a good recovery? What does it take to have a lousy, poor, lengthy recovery? For that, you got to see damage to the supply side of the economy. Somehow, we need to miss a whole window of investment, capex. We need to sort of lose the skills in the labor market because people are out of the job for too long. We need to see sort of a drag on productivity growth. The capacity of the economy to produce has to be downgraded. That can happen in crises if policymakers are sitting on the sidelines and if they don't know what to do, or they're too reluctant and too hesitant to do it. But that's not what we saw. Crises really enable policymakers and encourage policymakers to come together. You put a lot of the partisan politics aside and you get stuff done, and you did. And so the speed and the quality of the response was a much, much better narrative of looking at the prospects for recovery than any single model-based or even a collection of model-based indicators. First and foremost, the labor market distortions, they were extremely misleading, and the model couldn't have given you the right answer. The model never saw that level of unemployment, as you say, Jack. And so, look, I think it just goes to show, when it's plain sailing, a model is nice to have on the side. It gives you some feedback. It gives you direction. It knows the kind of prints that you're feeding it with, and it gives you sort of a reasonable answer. When you're in a moment of crisis, by definition, your prints are almost certain to be outside of the range that the model knows, was trained on, what you fed into it. Why would you expect it to give you something valuable in return? It's not a reasonable proposition.
What were the predictions from the models, or what specific predictions from the models were forecasting a general recession, where the model said, aha, just as from 2007 to 2009, we saw this, we're beginning to see this? Was it the decline in non-farm payroll additions, where the job market was still adding tons of jobs, but it was just adding less? Because I think a lot of economists focused, and market forecasters focused on rates of change rather than on the absolute level.
I think the extrapolation was specifically from the prior experience of 2008 and what followed. Unemployment rose not nearly as high as in the pandemic, but it rose to almost 10% thereabouts, and then it took a whole decade to work off that very high number of unemployment, right? And if you take that as a baseline and think, well, now unemployment is even higher, well, the logical extrapolated conclusion is that it's going to take even longer to get that recovery and to work down that level of unemployment. I think people did look at the level rather than the rate of change a lot. So the headline-worthy 14% unemployment rate is a levels number, right? And that makes for a great headline. Right, it's the worst we've ever had, and so the extrapolation to therefore the recovery must be the worst we're ever going to get was very natural. The levels versus change thing pops up in a number of places, but I think either levels or change can be misleading. I think to me, it's more about, does a number or a data print tell you a story? Does it make an actual argument? Does it allow for you to calibrate? Rarely, right? Numbers are inputs. And if you know the data well, you will know the weakness of most data series. They all have something that's not going to work for you. And so it's tough to navigate, I think, and to read these things by navigating by the data purely. We're going to have to tell narratives. We're going to have to tell stories that allow us to make sense of a cross-section of these data. And models are important. They're nice to have. but they are not your answer, particularly not in times of crises.
Forward Guidance is brought to you by VanEck. The VanEck Morningstar-wide Moat ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? Moat strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar-wide Moat ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks. Let's get back to the interview. You gave a TED talk on how to live with economic doomsaying, and I think that's an important phrase: economic doomsaying as well as doomerism. Do you think that one thing contributing to doomerism is the just staggering amount of data? Let's say thousands of data series, and if there are thousands of data series, no matter what, even if it's the best economy ever, there's always going to be a handful that look bad, and then so people who think the economy is bad, or want to promote a narrative that the economy is bad, can find those bad data prints. So for example, you said earlier, and you were correct, that the University of Michigan consumer sentiment came from a very low level of 51 in July 2022 to now it's 77.2. However, the Conference Board Consumer Confidence Index is actually still quite low. So for example, if I want to sell a narrative, I could say, oh, don't look at the University of Michigan, focus on the Conference Board, because that's worse.
The availability of data generally is a good thing, and I don't think that the plethora of data out there or the cadence in which it becomes available, I don't think that's what's driving the doomsaying. I think it probably lowers the bar for those who want to tell a negative story. And if we're honest, there is a big incentive in particularly financial journalism to tell the downside. It does drive clicks, and it's only natural. And this is not to sort of tear down journalism. There's a lot of great financial journalism out there, and a lot of the journalists don't even get to write their own headlines, right? They write a really good piece, and then the editor comes and tilts it into, hey, we're falling off a cliff. Why? Because you and I were going to click on that story. And so, yeah, I think the availability of data plays a part in this, and it allows you to cherry pick the negatives if that's your game. I kind of concur with you on that. But I think the reason we get this doomsaying slant just has to do with human nature. It has to do with the business of journalism. It has to do with our culture of public discourse. And all of that, is fine if you're aware of that. And if you know how to look through this, it's fine. If you know how to calibrate this, you just, sometimes you roll your eyes, sometimes you smile, sometimes you actually find it interesting. The problem is a lot of people, they don't spend their time thinking about economics and how we reflect on economics and the public discourse on economics. Executives in boardrooms, they have other things to do, but they will consume those headlines. They will be exposed to all this doom and gloom. And so what I experience day in, day out, and I do spend a lot of time in boardrooms, and I speak with executives almost every day of my working weeks. Often I go in and I see the impact of those headlines in their thinking, in their baseline for what's happening. So part of what the book really does, Jack, is to try to put some tools in the hands of those decision makers who weren't trained in this, who didn't devote their lives to understanding these things, but have a need to calibrate beyond what they hear on TV or what they read in the news stories on the economy. Not because it's not true what's in the news stories, they're reporting the facts and all, but there is a spin to it. And as we said at the start of this conversation, if you think about the last 4 years, the series of false alarms is somewhat staggering. And if you base decisions on it, you could easily end up paying for it. I mean, one example that I like to use is the automakers. The automakers did think this would be a protracted, long recovery in 2020. So they cut their semiconductor orders, and then they didn't have any. And then they went to the back of the line, and then they couldn't get their hands on them. And not only did they suffer financially from this, I mean, it's like lost sales and all that comes with it. It also did push up the inflation rate, right? I mean, it was a choke point of the economy was cars and then used cars because we couldn't make enough of the stuff. And you can trace that back to sort of a misreading of how big a recession would this be and how long a recovery would this be. And so I'm really trying to say, in the end, leaders, they're making judgment calls all the time in all aspects of their leading a big corporation. Investors make the same when it comes to portfolio construction and tactical positioning, et cetera. It's in the end, it's judgment calls with the help of instruments and tools and models, sure. But in the end, it comes down to judgment. Why would it be different when it comes to the economy? Like, why do you think everything works like that? Just for the economy, we can have an Excel sheet, and if we need an answer, we say calculate, and then there's the answer. It's not reasonable to assume that. It's too about judgment, and judgment is a hard thing to develop and to come by, and it's not something you easily outsource or buy. In the end, it's your personal call of how you will rate that situation, and the more leaders engage with that thought, I think that will help them to, over time, make decisions on the economy and what it means for them that will serve them well.
So what are those tools?
So it depends a lot on where we're looking across the economy, right? So I like to think of it as a three-way split of the macro risk landscape. And the book is constructed in that way. So we have a whole part on what is the real economy. There's a second part with multiple chapters on what you can term the financial economy. And then there is the third risk area, which is sort of the global construct of how the economy is set up, and what each of these three parts means for corporations, for investors, and what tools they can employ to cut through some of the clutter, the narratives that are particularly dominant, and risks that fall into these three types or these three economies: real, financial, global, if you will. Now, the tools are very, very idiosyncratic, right? It depends on what risks we're talking about. But to give you just one example that we almost touched on earlier, let's think about debt and sovereign debt. You will not believe how often I get asked by corporate executives about sovereign debt and how close we are to a sovereign debt meltdown, complete with a decay of the dollar and inflation and like essentially emerging market crisis scenario. That is a routine question in Fortune 500 boardrooms today. Often, and this is where we touched on today earlier, about levels, right? It's about the debt level. It's about the trillions of dollars in debt, or it's about the debt to GDP ratio, which is also a level measure of debt. And so one of the tools that the book makes accessible for leaders to develop their own view of, well, how big a risk is this, is to say, ignore the level story. Don't count the dollars of debt. Don't obsess with the debt to GDP ratio. A better tool is to look at the interplay of nominal growth rates in the economy versus nominal interest rates in the economy. If nominal growth exceeds nominal interest rates, a level of debt does not concern me too much. Why? I'm able to service that debt just out of current activity. I can hold the debt to GDP ratio constant. Essentially, if G is bigger than R, growth is bigger than rates. It's almost like a moving sidewalk at an airport. It almost gives you a tailwind. You're moving along, right? If interest rates rise above the growth rate, you're thrown onto that treadmill, and now you're having to set aside real resources to service that debt. And that's not game over, but that's a very, very different situation, a very, very different thing to be in. And so I'm picking this example. You asked me, I picked an example. Here's a tool, how to sort of lower the blood pressure on the sovereign debt meltdown narratives. I'm not endorsing profligacy and we need to have more debt and all that. Less debt is better, right? But it doesn't mean that a high debt to GDP ratio tells us much about risk for the US economy in 2025. Right, I'm much more interested in that rates versus growth story, and the book is full of such tools for people to come up with their own views on how big that risk is truly. Even as the headlines will scream at them, we're just an inch away from a debt crisis.
It is funny that some of the CEOs you talk to have concerns about national debt, because I imagine, unlike central bankers or chief economists, they have a very micro focus. They're not focused on the macro economy, and sovereign debt levels is like the most bird's eye view of macroeconomics. It's like, if one of your clients, obviously I'm just making this up, is Pepsi, and they ask you about sovereign debt levels, it's like, guys, People focus on selling more Pepsi. Okay, focus on growing. Don't focus on hiring people, and don't focus on making sure the caps are screwed on tight. Stop focusing on sovereign debt levels. I mean, do you ever, in a polite way, kind of, how do you communicate that?
Jack, I agree and disagree. It is the reality that that's what's on people's minds, right? They're decision makers. They're not just sort of producers of widgets or fizzy drinks or whatever the example might be. They're having to navigate a reality where they're constantly being told that this is one of the main risks, right? I mean, they're actually a very reasonable question to bring that up in a boardroom because, well, that's what they read in an op-ed in you name any of the publications. There'll be op-eds any day of the week that basically say, hey, look, U.S. debt is unsustainable and one more $1 billion in debt and we're falling off that cliff. Yes, there is a seeming disconnect. These are micro people focused on microeconomic problem solving and running a firm and generating value that way. But it's not like they're disconnected from the macro. They're swimming in that pool. And so I think it's very legit. And actually, I like that these questions come. What I sometimes struggle with, and that's part of the motivation in this book, is that they're always to the downside, seemingly. They're always sort of in the crisis angle and perspective. And often they give too much credence to or they take at face value, essentially, some of the risks that are articulated in op-eds and headlines, et cetera. When, again, look, I'm not poo-pooing public debt. I'd like it to be lower, right? And it'd be good if we can get it down, and we can talk about it tactically in 24 and 25. And there's a great opportunity to actually have lower deficits now, and that would be stimulative because it would allow the Fed to cut rates sooner and all that. But look, I think that the bottom line is this is part of their reality. So they're asking, and we need to give them calibrated answers, not hysterical answers.
Yes, and going back to the level of the debt, you said that G should be greater than R, and if G is greater than R, it's not as big of a problem. So if the economy is growing at a higher rate than the level of interest on the debt, then it's less of an issue. So right now, for Q1 GDP is at 5.4%. I imagine that forward-looking indicators are a little bit lower than that, and the 10-year yield is about 4.4%. But the average yield on extant US Treasuries is 3.3% because the US Treasury did a lot of financing when interest rates were low, and those rates are still locked in. So when you said that growth should be greater than the interest on the debt, are you talking about kind of the spot rate that if the government borrowed right now, or of the average interest rate paid on the existing debt?
Either, it's basically a directional guidance here. You're absolutely right. We need to look at what is the new incremental debt, how is that financed, and then you want to look across all the maturities and understand, well, what does that mean? And the 2010s were in a uniquely favorable decade in terms of R versus G, right? I mean, financial repression, QE, the very low rates, they basically meant that even that growth was kind of meek and disappointing. I mean, rates were so low that the spread between R and G was super favorable. It was very easy to carry those debt loads, right? That is kind of gone. I don't think we'll return to that. So the ease with which we carry the debt load is not as favorable as it was in the 2010s, or won't be as favorable as it was in the 2010s. But if we look at that R versus G story, we can get to a calibration of, well, when does it get painful, right? And whether you look at sort of new incremental debt or whether you look at sort of the average maturities and rates that you have across the debt stock, both of these are sort of, doing the detailed work on this. But the bottom line remains, do you believe in a 10-year yield over the next, say, through the end of the decade? Do you believe in a 10-year yield that is consistently significantly higher than nominal GDP growth? Well, if you believe that, then you should probably be more worried about the debt stock. If you think the 10-year yield, just as a proxy, for R, if you think the 10-year yield is lower, maybe not much lower, but lower than nominal GDP growth most of the time, perhaps significantly so, well, then you should be less worried about the debt stock and adding new debt, right? And so this is where this kind of analysis, I think, adds value. You need to think of risks. You don't want to pin it on a single indicator like the debt level. You want to look at it dynamically, and you want to, of course, understand what goes into G, the growth rate, and what goes into R, the interest rate. Those two are the two variables that matter, and a myriad number of other variables impact R and G. So it's not simple, but it's certainly, I think, more helpful than looking at the debt to GDP ratio and claiming we have a problem. Maybe let me just add that one more thought. The level of debt, if you look globally, the level of debt is rarely a good indicator of sovereign debt risk. You have countries with very high debt stock and debt to GDP ratios like Japan, and there's no inkling of any sovereign debt crisis. And then you have countries with much, much, much lower debt to GDP ratios than the US that have had defaults, such as Ukraine in the 90s, right? And other examples I don't have at the top of my head. So the information that is contained in levels of debt about debt risk just isn't what it's made out to be in public discourse. I'm not saying it doesn't matter. Of course, I'm interested, but it's way too redux to sort of claim there is a sovereign debt problem based on levels alone.
So would you say that Japan, where the debt to GDP ratio is about 250% and interest rates are low, I mean, even if they've risen, they're the 10 years at less than 1%, and GDP, I imagine, I think is higher than that. So you'd say that's not a problem because even though they have a mammoth debt to GDP ratio, R is still less than G. Whereas a country that has only 50% debt to GDP ratio, but interest rates are higher than the growth rate, that is where you would have concern. Is that right?
Pretty much, yeah. You want to look at this over a window of time, not just a moment in time. But if you see a country with consistently higher interest rates than growth rates, that becomes painful because you're going to have to use current growth to service that debt, right? You're going to have to set aside resources to service that debt. And so I essentially view that as a much better gauge of risk than anything else.
How do you think about the future of debt to GDP? I mean, is there a limit on the debt to GDP? I think Japan is the highest one with 250, 260%. I mean, if the US continues to run a fiscal deficit, debt to GDP ratio will go up from 120%. What is the limit, and how do you think about as debt levels continue to increase?
Yeah, but see, this is exactly what I mean. There isn't a breaking point that we can point to. There isn't sort of the straw that breaks the camel's back, and we can look at it on the y-axis. It's measured in trillions of dollars or in debt to GDP. It's not going to work like that. I mean, you had academics like Reinhardt and Rogoff. They try to argue exactly that, right? I mean, they try to give academic credence to the idea that there is a breaking point on the debt scale. And they said I forget the details, but like, what was it, 90% debt to GDP, and then growth will collapse, right? Well, it just didn't happen like that. And I think for good reasons. I think that the reasons are R versus G, if you're in a world where your growth allows you to service all this debt very easily, well, the debt to GDP ratio is not going to overrule that and give you a debt crisis. And so I think there isn't a measurable pain point. There isn't a number on the scale that will give us the crisis. I think if we entertain a sort of sovereign debt problem in the US and want to be more specific, it'll have to be essentially a longer period of time where longer dated debt duration materially rises above nominal growth. And that is a problem because it will force trade-offs, much bigger trade-offs. If we have a window of time where interest rates, duration, longer dated securities, 10-year yield, say as a proxy, if that rises durably, considerably above the nominal growth rate, right? Not just like in a month or in a blip, but like, we're moving into a window, an era where we're seeing that persistently above the growth rate. That will be interesting, not because it's a sudden death or sudden stop kind of scenario. It's because it would force a lot of trade-offs in how we finance the economy, how we run the economy, how budgets are constructed. They're going to be real setbacks in what can be done and what can't be done. And so that is something, that is a criterion I'd have to see. Duration rising for a longer period of time, significantly above the nominal growth rate of the economy, right? I don't expect that. I do think that rates will be higher. I do think the neutral rate of interest is higher. I don't think we'll return to what we had in the 2010s. But I don't think that rates will rise above growth easily or permanently or significantly, such that we have those constraints that make it hard.
Hello, everyone. Permissionless 3 is coming to Salt Lake City on October 9th. The event for crypto natives is heading west, and we are bringing the biggest names in crypto together for an insane, can't miss event. Hear from more than 200 industry titans, including Balaji, Mike Novogratz, and Dan Tapiero. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups and L2s, institutional adoption, and of course the November election that will be right around the corner. We couldn't be more excited about this event. Get your ticket today and make sure I get some bragging rights by using my code FG10 to get 10% off. That's FG10. Stands for Forward Guidance. I want to see you there. Do it. It's going to be at one of the most beautiful places in the United States, and everyone's going to be there. Van Spencer's going to be there. Jim Bianco's going to be there. Jan VanEck's going to be there. So what are you waiting for? Get your tickets now by clicking the link in the description and use code FG10. Back to the episode. Thank you. What's another tool you read about in the book about where people may have a misunderstanding and they may be seduced by narratives and false signals?
We can go anywhere in that risk landscape. We talked about one in the financial realm. I can talk about one on the real economy side, if you will. We talk a lot about productivity growth. We have 2 chapters on productivity and tech, and sort of what are the promises of tech to lift the growth rate. There are also, I think, misconceptions around how does tech actually deliver growth. We often hear about amazing innovation on the consumer side. So people love to talk about, Uber and, look at how amazing the Uber app is. And this is an example of technology lifting the economy. Well, if you look at it in a very sober way, the bar for productivity growth coming from tech is a lot higher than that. In the end, you're going to have to see displacement of labor. Right? We're going to have to cut out labor to realize cost savings and all that. And Uber doesn't do that. The production function of an Uber ride is no more productive than a classic taxi. The capital input remains a car. The labor input remains one driver. There's small productivity gains from matching rider and driver on the app, but there are studies on this. It's pretty marginal. A bigger signal in the Uber app is it's more expensive than a classic taxi, right? I mean, in New York City, my ride from my office home to my apartment is about 50% more expensive on an Uber app than if I get a taxi in the street. So there are no productivity gains from that. There would be productivity gains if we're cutting out the driver, right? The labor input. And so what we're saying in the book on that is, you to see widespread productivity gains in the economy, technology will have to, do large scale displacement of labor. Without that, it's great to have the technology. It maybe allows you to move ahead of competitors. Sometimes it's table stakes. You're going to have to make the investments in technology. But just because technology is around and impressive, it doesn't mean productivity sort of sees that lift. And what's interesting too is we've had productivity growth in the physical economy all along. Yes, productivity growth rates are low, but not really in the physical economy. What has dragged down aggregate productivity growth in the US over the last few decades was the inability of tech to move the dial in services. Services is just much harder to replace labor. You've done it on the assembly lines, you've done it in production, you've done it in agriculture very effectively, but you just didn't have the technology to do it in anything from education to healthcare. This is really proof to me that when we talk about productivity growth and technology, the intersection of the two, we need to look very hard at sort of criteria at the macro level that credibly give us that lift. And when I look across the debate on that, often it's just too simplified and it's too tech gullible. I think there will be a lift in productivity growth. I think it will be more modest and somewhat slower than a lot of these aggressive, somewhat hubristic estimates out there. It's happening, but it's going to be incremental, cumulative, trial and error. It's not happening overnight. And this is another example of these tools of how to calibrate sort of in this case the growth environment.
So I'm totally with you, by the way, about Uber. I really don't see how Uber is, any more efficient than a New York City taxi cab. Although maybe in suburban areas it is a little bit, but then you've got to have a company called Uber where you hire all these software engineers, and you've got to have investment bankers raise money and that kind of type of stuff. But when you said that in order to have productivity growth, which is mathematically, I think it's the how much GDP do you get out of like a unit of labor or capital, but labor productivity, you're going to have automation or AI displace labor. What do you mean by that? Do you mean that it's one person who's able to do a lot more and people are just, or that the person entirely is replaced by AI, or both?
So both can be a path to productivity growth. It's either producing the same with less inputs or producing a lot more with existing inputs, right? Both are productivity growth. Historically speaking, Jack, when you look at big shifts in productivity growth, they've always come when we cut out a lot of labor. And by the way, that doesn't mean mass unemployment because of technology. I think the whole technological unemployment story is total nonsense, not at all borne out in history. I really don't expect that for AI either. We can talk about that too. But what I really think is important and what the book goes to great lengths at to just explain that, all big shifts came with that, displacement of labor. And just one example off the top of my head. Once upon a time, late 19th century, I think 1870 would be the cutoff point. Nearly half of all Americans worked in agriculture on a farm, right? Like your ancestors, the chance of having one on a farm is 50% basically, right? Successive waves and Americans spent almost 45% of their incomes on food. So food was very expensive. And what happened with successive waves of technology is that we've displaced all that labor. Today, less than 1% of Americans work on a farm, and the share of our budget going to food is just 12%. Okay. So technology is massively deflationary, right? It lowers prices. Why? When I have a better way of producing stuff, I'm going to lower my price to grab your market share. And there is a downward draft, there's a cost competition, which, by the way, isn't rosy for all firms. It's pretty cutthroat. You can sometimes see margins whittled away to almost nothing, razor thin, right? The winners are consumers because consumers are experiencing this real income lift. Like if I spent 50 or 45% of my budget on food and now I'm spending, 15, well, I have a 30 percentage point gain in my budget, right? And what am I going to do with that? I'm going to spend it on stuff that may not even have existed at the time the technology first hit us, right? In the same way, AI, I think, will do the same way in the same format. Essentially, tech is deflationary. Firms that will produce more cost effectively, they're gonna grow by taking competitors' market share, by lowering prices, and that will raise your and my real incomes. And we're going to go and we're going to buy it, and we're going to spend it on stuff or buy stuff that we may not know about today, right? So I think these are some of the narratives, column instruments, or tools or tricks, but sort of ways of framing common macro propositions, problems out there in the public debate that the book sort of systematically goes through and makes a case for how to look at it productively. We don't own the right answer. I don't know, the future, but I'm pretty confident that technology has an important role to play in the way that I try to just outline.
So I think that's a really important point, that in the 1800s, if someone said, okay, now one out of every two people are working on a farm, pretty soon, in a few decades, it's going to be one in 10. And then shortly thereafter, it's going to be one in hundreds. that people will be worried about mass layoffs and what are people going to do. Of course, with the benefit of hindsight, we know that people left the farm, they found jobs in cities, in factories, in manufacturing, producing clothes, finance, technology, all sorts of stuff. But Philip, what is those jobs of the future? If so much is automated away, what are these future industries? I mean, is everyone going to be an Instagram content creator? I mean, I guess healthcare has been secularly adding tons of jobs, but I mean, is
Right.
70% of the economy going to be healthcare? Where's the jobs? What
Um,
are the jobs going to be?
well, yeah, it's a great question, and I two or three thoughts. I mean, one thing is, as I mentioned earlier, often we end up consuming stuff that would have been unimaginable at the time when the technology first hit, or we're doing jobs that were simply not foreseeable. So when the internet hit, you didn't think about social media content moderator jobs. They're said to be paying pretty well, six figures, I hear here and there. So it's simply unforeseeable, right? We don't know. I think the obvious answer, though, to your comment and your argument, Jack, is jobs will shift towards those types of activities and tasks that are the hardest for technology to penetrate and to take over. There will always be those things. More personalization based jobs, high risk things, working with humans. You mentioned healthcare for a reason, I suspect, because that's obvious. Care of the elderly, yoga instruction, personal trainers. I mean, look, I'm not saying there's going to be an economy of yoga instructors and personal trainers, but will the job profile collectively be skewed towards those types of jobs because others are more easily taken over by technology? Yes, I do think so. And then a third thought, look, I'm not a proponent of narratives of superabundance or singularity. All right, I don't believe that in anytime soon, maybe in my lifetime, nobody has to work and everything is just sort of produced by robots and algorithms and everyone's just on an extended holiday. I don't think it's very likely at all. But if it is that way, I mean, how is that a bad thing, right? I mean, if you really have a world where all new jobs either go to robots in the case of physical production, or they go to algorithms in the case of services delivery. Well, we live in a world of superabundance where you essentially solved economics, right? Economics is about decisions and optimization under scarcity, right? If you don't have scarcity, you've basically solved that problem, and then that would be a good thing, presumably. And we should think about, can we do with all that time? I mean, again, I don't, that's not at all. And the book doesn't argue that. And I'm not a technologist who dials up sort of the singularity theme and all that. But I think it is a valid part of the conversation when we think about the future of jobs. If you really think that technology kills all the jobs, well, it's not clear that that is a bad proposition if it's actually successfully done.
Yes, provided that the gains of those productivity are somewhat equitably shared.
Yes, that is a important proposition. By the way, I mean there are many steps along the way where governments, policymakers do have a role to play, right? When we think about the deflationary effect of technology, right? So cost savings lead to deflationary effects. Why? Because the most cost-effective producers don't lower prices. Well, they do that if there's a truly competitive situation. Well, if it's not competitive to begin with, you lower your cost, you just collect a fatter margin, and that may be it, right? So we do kind of rely on broadly competitive structures. As we all know, we're all over the place in that regard. There are certain areas of the economy that have more of a competitive setup. There are others that are more oligopolistic, and I'm not in the weeds of those types of perspectives. That's not where I'm at home. But yeah, it's clear to me that we have a need for ensuring and enforcing some of the competitive underpinnings.
Yeah, I should also say you've also got a co-author of your book, Paul Swartz, who works alongside you. Going back to the recession point, I actually was watching an interview with the great investor Peter Lynch in the 1990s, probably mid 1990s, and he said how everyone had been forecasting a recession for 4 or 5 years in a row, and it hadn't happened. Maybe it was in the like 1997. Has that always been the case that people are seeing these false alarms and everyone is, people are often worried about a recession that doesn't happen? Or do you think there has been an increase in the frequency of that actually now in 2022, this recession mania, there is something different that, in the 1998, yes, there were economists who forecasted a recession, but people weren't obsessed with it like they are now.
I haven't looked at that. Sort of how has the proclivity for doomsaying changed over the long run? It's an interesting question. I mean, I guess you could sort of take headlines over the long run and try to do some machine learning based natural language processing kind of analyses. It's just sort of the negative skew. There are people who do that. I'm trying to think. Is it one of the feds, one of the regional feds that has a indicator of that? I'm not entirely sure. I think in the end, what we discussed at the very start of our conversation, the logic for the downside, for the doomsaying version of the economy is compelling from a number of perspectives. Certainly the news business, but also, if we're honest, it's sort of in our nature to think about the downside, right? It's just something that matters and that we click on. And so I don't have any evidence that this has changed materially. I think maybe the velocity of news, the velocity of the debate, all that has picked up. Maybe that feeds into this and dials it up, but I have not analyzed that.
And then how can people safeguard against being properly worried and properly preparing for serious threats that do pose a serious risk? In other words, if recession risk of 2022 was a little bit overhyped, maybe there are, the inflation risk in 2020 and 2021 was definitely underhyped, I would say. I mean, when we got to 9%, there definitely are things that are underhyped as a risk. How do people prepare for that?
It's interesting on inflation. I would probably disagree with you there. While you're right that sort of the spike of inflation was higher than most people dare to believe and argued and predicted, and therefore may appear to be sort of underestimated, let's not forget that the conventional wisdom was very much about a 1970s style structural inflection, right? A wage price spiral, structural meltdown of the inflation regime, and all that. And so, in my view, from my perspective, I think we overestimated the inflation story.
I would agree with you. Once the price of oil went to $120, from then on, inflation as a threat was overhyped. But I'm talking about in 2020 and 2021 when inflation was at 4% and the Fed was saying, don't worry, guys, it's transitory. That is when I'm saying it's underhyped.
Agreed. Yeah. You're absolutely right. There's a tactical, there's a structural aspect to the inflation saga. And one was I think, underestimated and one was overestimated. But yeah. Look, I think what can people do? Look, in the end, it comes back to there aren't sort of decision rules that you can write today for these risks. And then when it happens, you're going to press this or that button. In the end, these systems are so complex, right? And the way the risk is shaped is so interconnected and unpredictable. You can't prepare much for much of it. Most of it is having the muscle to go along in real time, analyze in real time, and decide in real time. I wish it were different, like that we could say, look, there's like 4 ways this can go wrong, and if A or B or C happens, we're going to do this or that. I think in the end, they're so idiosyncratic the way these things unfold. They're so in the moment, so specific. I think this is why we're hammering the point about judgment. Right? You gotta, think about these risks ongoingly. There's nobody to give you the answer, no forecaster, no headline. You're going to have to make sense of it with respect to your portfolio or your firm in the moment. That comes down to judgment. Leaders do that all the time in all other aspects of their leadership. You're going to have to do that in macro as well.
And so would the advice or the conclusion be to not make decisions based on macro because it's inherently unknowable? In other words, if professional experts and people who have PhDs and whose job it is to forecast the economic cycle, if they are regularly so wrong, what chance does someone who's not a professional forecaster have a chance? Or are you saying actually no, you can forecast macro and prepare for threats. It's just that the way that these fears are publicized, particularly in the media, can be misleading at times.
Well, in the book, we're certainly taking the position that you can improve your hit rate and you can be directionally right and you can get the narrative right. And that can save you either a lot of pain and dollars, or it can give you a head start in other areas. Both are sort of risks. Missing the upside is a risk. Walking into the trap is a risk. Well, what we're saying really is sort of the idea of point forecasts and pinning this and quantifying this and timing this. It's exceedingly unlikely that you'll do that consistently right, as we saw in all these instances we've discussed of failed predictions, which regularly skew to the downside, right? And so we're really more about getting the narrative right, the tools to have a better hit rate on some of these things. They're there. One can engage with it. But if the attitude is, well, let's forecast this, give me the answer, where's the economy going to be in the third quarter of 2025? This is where we're very, very cautious. It's not going to play out like that.
You've given a lot of salient advice about how when there's a lot of doomsaying, how to safeguard against that. I would say now there is a lot of optimism. At least there's a lot of optimism priced into markets. That the narrative, what you hear and what you read and see on Twitter, might be different. But based on what asset markets are pricing, where credit spreads are, where equity risk premium is, whatever valuations, it is pricing in a soft landing. That real growth is high, and that nominal growth will be higher than inflation, and that there won't be a recession. How are you thinking about that? What false signals are you seeing right now?
No, I think that's absolutely right. And by the way, I think markets had a better view on these risks than the commentariat and the pundits and the forecasters. I mean, it's hard to look at the way markets have played the last few years and say they got that completely wrong, right? I mean, it's clear that, to me, that sort of the collective information embodied in prices is significant there. In my view, we shouldn't be debating whether we have a soft landing. I mean, we're in the middle of a soft landing. We're constantly moving the goalposts on that story. I mean, remember Larry Summers, he said that, what was it? You need a 6% unemployment for I don't know how many quarters to bring inflation down to, what was it, 4%? I mean, I'm paraphrasing, but I mean, clearly, the soft landing, what's the bar for a soft landing? You had to cool the labor market, like job openings, without pushing up the unemployment rate. Did you do that? Absolutely. Are you well into that process? Yeah, 21 months or something like that. I mean, it's kind of funny, I think, that we're still debating, does it happen? Will it happen? Might it happen? You're in the thick of it. It's happening. Does it go all the way? Is it going to be sort of, the completion? Will we never see a recession again? Of course we'll see another recession, and then people can say, see, it wasn't a soft landing. So to me, this is already a big success. We didn't get the supposedly inevitable recession. You did cool the job openings rate materially. I think to the tune of 3.5 million jobs that were once open or advertised for, now they're gone. The unemployment rate is super low, near record low. So all this is there. So in a way, now that this is more accepted, it's priced better. I think we're waiting for new information, for new shocks. Look, there's the reason markets have been so placid the last months or so. Super low vol, around 8 or lower last time I looked. Why is that? Well, is it a big difference whether you get no cut or one cut, or even if you want to argue sort of the contrarian case that you're going to get one more hike? Is it sort of the big material difference that should give us a big volatile moment in markets? I don't think so, right? And so we have a continued strong labor market that's basically too strong for monetary policymakers. We have a consumer that, yeah, sure, we had some weaker prints recently. To me, that doesn't make a trend, comes off very high levels. We have household finances that remain solid, right? We have, wherever you look, we can go through the list. This is not a weakening or poor economy by any stretch of the imagination. So I think, unless you get a shock, right? You can always get an exogenous shock that remains entirely unpredictable. aside from pandemics, you have solar flares, and you have, we haven't talked about geopolitics today, by the way. I don't know if you still want to go there. But, I think without a big shock, whether exogenous or endogenous, growth isn't great, but it's respectable. Inflation's coming down, not all the way, not as fast as you'd like it to be, but nobody said it was a perfect glide path to 2% and it's over. It's like, to me, this putters along and markets kind of reflect that. I don't see today anything that would say, oh, and here's the argument why this comes to a halt.
I have done the back test a few years ago, but I don't have the data now. But I think the back test of when the unemployment rate is very low and it creeps up a little bit to being slightly less low, but still low, that often is a recession signal. So you're right, the unemployment rate has not shut up, but it's gone from 3.4% to 4.0%. A lot of that has been people entering the workforce because that's the denominator rather than people being laid off. So you're right about that. But would you say that's a false signal about going from very low to less low?
Yeah, I think so. I mean, to me, the unemployment rate going from 3.5 to 4, there's just nothing about layoffs. It's all about the denominator, as you say. So that doesn't do anything to me. I haven't actually heard of your other rule. I mean, there's so many rules out there. I mean, the quest for the holy formula that gives you the decision rule. I mean, we talked about it a lot today, right? I mean, and we only mentioned like 2 or 3. There are probably 20 or 30, right? And the one you added now is one on that long list. Some will perform better than others, but when I worked on the sell side, I did a bunch of research notes on just the yield curve and how it's like perfectly imperfect recession indicator. And that was long before COVID. It was like in 2017 and 18, I forget the years, where we said, look, there's so much stuff and so much noise pollution in the yield curve. If you want to run a model on a portfolio based on that indicator, sure, do it, but we don't think you're going to get much value from it. In the same way, I would say I would strongly advise against using any other such rule of thumb or other shortcut. It's just unlikely to serve anyone very well.
And you mentioned geopolitical risk. How do you think about that? Because across world history, certainly are places where geopolitical risk has impacted markets. I mean, if you're an investor in the Russian equity market and then it got taken over by Bolsheviks, clearly, you got zeroed. But when I think of geopolitical risk within America, we have oceans on either side of us, and it doesn't seem like something that's very important to the world and to, it's on CNN and it's the front top page and it should be there and it's really important to humanity, but it seems to always matter a little bit less to markets, particularly the American stock market. Would you say that's accurate?
Yeah, I totally agree with that. And the book, the whole third part is about the difficulty of translating geopolitical stress and crises to macroeconomic impact. It's really hard, but there too, you have the doomsaying slant. We often assume that a crisis halfway around the world must mean a lot of negatives for the US economy. The bar is really high. Right. And by the way, not just in the US. I mean, just think about the Ukraine war. And everything I'm about to say is not at all to belittle the calamity this is, and the tragedy this is, and the unspeakable disaster it means in so many ways. But did the Eurozone have a recession? No, it did not. Did European industrial production fall off a cliff, as myriad people said? No, it did not. I mean, European industrial production, inflation adjusted, is roughly where it was before the start of the Ukraine war. Same could be said about the Hamas war. What impact has it actually had on oil prices? Has it done anything to the US economy? It has not. And so we need to differentiate what is happening geopolitically, which is very important in its own right, very complex, very hard to predict in itself, right? Geopolitical prediction is probably as hard, maybe harder than macroeconomic prediction. And then you have this extra hurdle of translating into macroeconomic impact. You're compounding complexity of prediction here in a really hard way. And keep in mind, sometimes even the direction of impact is out of reach or confounds people or wrong-foots them completely. So one example we use in the book is the 2 world wars. When World War I starts in 1914, you get exactly what you expect. Stock market sells off, they shut it down for 136 days. I mean, imagine that, shutting down the stock market for like, a third of the year. And then you reopen it and the stock market drops another 20%. I mean, that seems entirely fitting and perfectly reasonable for the start of a world war. And yet in 1939, when World War II begins, the US market pops, goes up 13%, stays up until the fall of France, which is later. Well, why? Because it ends the Great Depression. In macroeconomic terms, it's a massive tailwind to the economy. You're ending, the deflationary problems. You're putting people back to work. You're investing. You're producing. The whole thing is basically solving a decades-long macroeconomic disaster. That sounds callous and that sounds nihilistic, but markets and the economy are not moral weighing machines. They are, discounting prices. And if you run a firm and you want to know, or a portfolio, and you want to know what is a geopolitical hotspot, crisis, or war do to my business or my portfolio, you're well advised, I think, to take a step back and think precisely what are the transmission channels that can actually do damage in the US, in your portfolio, in Europe. And those transmission channels we lay out four, I think, in the book. Like, the first is sort of the real transmission channel. So, does spending take a hit in America? Does investment take a hit in America? These are the things that can give you a downdraft. They can land you in a downturn. These are legitimate sort of risks. But for a geopolitical crisis, even a big one, to do that halfway around the world here, it's tough. Particularly, it's a high bar. Particularly if there were no pre-existing connections into that part of the world. Like, the linkages between the US and Ukraine and Russia were negligible. Then the second transmission channel is sort of financial. You think about the balance sheet effects, you think about who's exposed, are banks implicated? You mentioned sort of the loss of assets today, all that's very interconnected. And yes, some European banks did have that exposure to Russian assets and they were hit harder, but there wasn't enough linkage there in the US or even in the Eurozone as a whole to say that this transmission channel, gives you the certain recession and slowdown or downturn, or call it what you will. And then I think another transmission channel is more institutional, the rules of the game. Like, a big crisis can change the rules of the game. How do we conduct business? How do we collaborate? What is on, what is off? What's on the sanctions list and what is not? And so those three transmission channels, I think, are a way of looking at this in a very sober, non-hysterical way, looking for evidence of how geopolitical conflict actually does damage in macro terms. I think, if you do that, you often arrive at the conclusion that the bar is really high for damage resulting from geopolitical conflict, with the extra comments. It's always different for the individual idiosyncratic firm, right? I'm talking macro. I'm talking the aggregate. I'm talking the whole thing. Well, if you're a firm that operated in that part of the world, if you had supply chains or value chains that ran through that or impacted by parts of the sanctions regime, otherwise, of course, for you, this is all that matters. And this is all very real. And the impact is everything. But this is a common mistake, I think, in macro. Your firm is not the economy. You can't easily extrapolate from what you're seeing in your portfolio or in your business units to what is the reality in the macro economy as a whole. And that's very treacherous. It's very easy to mistake those two, conflate them. And particularly in geopolitics, I think that's something to keep in mind. You individually may be hard hit. The bar for the economy to be hit hard is higher, much higher.
And what about a breakdown in relationships between US and China? Some people are calling it a new Cold War. Perhaps that term is a bit dramatic and an instance of a false signal, media getting ahead of itself. But, if you're a producer of luxury fashion that China buys a lot of, that will impact you on the micro level, to your point. But what will be the macroeconomic implications if the US, whether it is Trump or Biden, it continues to increase tariffs on China? Will it be bad for the Chinese economy? Will it be good for the US economy because we're producing stuff here? Are tariffs bad for growth? something that I think dominated thinkings, from probably the 1980s to 10 years ago, but now is the consensus is maybe shifting a little bit. What do you think?
Yeah, I mean, like, how much faith do you want to put in the textbook, right? Where trade was everything, and trade liberalization was going to be eternal prosperity and all that. Look, I mean, the fact is, right now, U.S. investment and fixed structures and infrastructure and semiconductor plants is through the roof. It's a direct consequence of geopolitics, not to the downside, but tactically and even structurally in terms of what we're building on the supply side in the U.S. It's a boost, right? Would better specialization with no friction and geographic specialization, would that be preferable? I think so. It'd be better if we didn't have that. But is it possible to argue we don't want the Micron plant in upstate New York? Do you not want the TSMC plant in Arizona? I think you do, and it's going to boost capital expenditure. It's going to drive employment. Not to mention some of the sort of more strategic considerations that go into that in terms of self-sufficiency and autarky and such critical components. Just on the pure macro tactical side, it's exactly what I mentioned earlier. Seems a no-brainer somehow that all of this is bad. Well, it also has positives. It has boosts, and generally, I think even if you get a pretty stringent decoupling, between the two major poles, that doesn't mean that you have a structural downgrade of production and investment. On the contrary, you're going to have to duplicate some of this at higher cost, and maybe that feeds into somewhat higher price pressures and somewhat higher rates. But the idea that it sort of leads to a meltdown, a sudden stop, we'll adjust it to this in many, many ways. And so in the book, we don't think of these pressures as undoing what we see as an essentially strong 2020s. We believe in the book, in an era of tightness, a really structurally tight labor market that underpins everything in the U.S. economy. And it will lead to better growth, better real wages. It will lead to upward pressure on prices, but we view that as healthy if prices and interest rates are somewhat higher, not too high. We think it will lead to better capital allocation, better productivity growth. And geopolitics is a big story and risk factor in this. But short of a big war, like great power war, we don't think, or we don't expect in a base case, that geopolitics will dominate the story or overrule the story of the era of tightness that I just tried to sketch.
Got it. Thank you. Well, the book is Shocks, Crises, and False Alarms: How to Assess True Macroeconomic Risk. Philipp, it's been great having you here, because a lot of time on this program, I ask people, what are some risks that you think are underappreciated in the market? And it's been nice to have the opposite conversation about risks that, with the benefit of hindsight, have been overappreciated and false alarms. But the final question I'm going to ask you is there a risk that right now you think is not a false alarm and actually people are not worried enough about it, rather than being too worried about it? What's your black swan?
Yeah, what's my black swan? You know what? I'm going to say a solar flare. just
Okay.
to make the point. There's plenty of risk out there. I don't want to dismiss any of it. But what is the thing that is truly unpredictable, that I can't sort of measure, view, truly exogenous? Yes, a solar flare is sort of standing in as a proxy for that. Not because I think it will happen, but these are the types of things that will make us scratch our heads.
That is, I mean, I've never heard that before. So that's a true black swan. Philipp,
It,
thank you so much for coming on. Pleasure chatting with you.
it was nice talking to you, Jack. Thank you.
Thanks for watching. Remember to check out vaneck.com/moatfg to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.